bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the September 16th, 2025 episode. My guest this week is Mark Shelburne. Mark's a housing policy consultant with Novogradac, and he's based in Raleigh, North Carolina. Mark is one of Novogradac's leading experts in consulting with state agencies, local governments, and others on affordable rental housing and private activity bonds. I'm really excited to have Mark on this week. Now, he and I are both back from Novogradac's housing conference that we held in Hawaii, in Honolulu last week, and we're both going to be together again next week in Nashville, Tennessee. Now, Mark is here to discuss with me the ways in which state housing agencies are implementing the lowering of the tax and bond 50% finance by test down to 25%. Now, as our frequent listeners and viewers know, Congress passed this provision so that states could finance more affordable rental housing, given a certain amount, an existing amount of private activity bonds. Now, implementation-wise, state housing agencies essentially have three choices. And when I say state housing agencies, I'm really referring to the agencies within a state or possession that have the authority to allocate bond issuance to various activities. So I'm going to colloquially be referring to the state housing agencies, knowing that it's done differently depending upon which state that you're in. California, for instance, has the California Debt Limit Allocation Committee. But that's what I'm thinking of when I'm thinking of state housing agencies, those who make the decisions about the use of private activity bonds, because private activity bonds can be used for more than residential rental housing. But given that as a caveat to our discussion, state housing agencies can start implementing the new rule on its effective date as of 1/1/2026, so just a few months away. State housing agencies could also choose to wait until 2027 and spend 2026, the balance of this year, 2026, deciding how they're going to implement it. Also, a third option is the state housing agency could really lean in to this new rule and start taking actions in 2025 to build and finance more affordable rental housing. Now, clearly, how states choose to implement the lowering of the 50% test will directly affect how many additional units that can be financed in a given state. As you can imagine, we have a lot we want to discuss. So if you're ready, let's get started. Mark, welcome back to Tax Credit Tuesday.
Thank you. Glad to be here.
No, it's great to have you here. It was good to see you in Hawaii last week. I look forward to seeing you in Nashville next week and then Las Vegas in December. So we'll be seeing a lot of each other in the weeks and months ahead.
I thought about wearing my Hawaiian shirt for today.
I should have done the same, but I was actually thinking of going a little bit more country western.
There you go.
National. I'll also note that Mark last appeared on Tax Credit Tuesday in an installment of our So You Want to Be a LIHTC Developer series, where we talked about what developers should know about working with cities and counties. And that's definitely something that is relevant to what we're talking about today. So I'll include a link to that episode in today's show notes. But before we dive into today's episode, Mark, I wanted you to first describe your life before Novogradac, your professional life before Novogradac. I don't want to, I'll narrow that. Professional life before Novogradac, and then share what types of services you provide to Novogradac clients.
Certainly. So I spent 13 years as the counsel and policy coordinator for the State Housing Finance Agency in North Carolina. I also ran the housing programs for the state of Georgia for about a year. But I've been with Novogradac. Other than that year in Georgia, I've been with Novogradac since 2015. And most of my client work is working for state housing agencies. And so most of that has been revising qualified allocation plans. And I look back, I've done 40 of those with the firm. So that's an average of about one every 10 weeks.
Wow. A lot of plans.
Indeed.
So thank you for that. I wanted to start the conversation with just a basic level setting. I say that a lot on the podcast. I probably need to come up with a different way of saying it, but make sure we're all starting at the same place. Please explain to the listeners the significance of what it means to lower the finance by test from 50% down to 25%.
Certainly. And I'll refer anyone who is not familiar with these basic concepts to your podcast that you did. I believe it was last week with Charlie and Julie. We all explained
Yes.
a lot about this, but the basic concept is projects can qualify for the 4% tax credit if they have an allocation of tax-exempt private activity bonds. And the amount of private activity bonds that they need all the way up through history. Well, actually, there was a point in time when apparently it was a higher percent long before my time.
The 86
Right.
made it a 70% finance by test.
Exactly. And so I've been around for a while, but that was before me. And so, but since my time, it's been 50% of aggregate basis. And so starting in 2025, that's now 25%. So cut it in half. And so the main consequence will be for states that are bond cap constrained. And our firm and Tiber Hudson keeps a running list of states that are constrained. And the latest that I have seen is that it's 24 of them have more demand than supply for private activity bonds. So in other words, when developers apply, there's some form of competition, whether it's first come, first serve or points or however, or like in Texas, a lottery. There's different ways that it works. And so this change will be of greatest consequence in those states, but really any state could become one of those at any point in time.
And you mentioned that in 2025 is when the law passed, and the law takes effect on January 1 of 2026.
Yes.
So generally speaking, if a project is placed in service before the end of this year, it needs to finance 50% or more of its aggregate land and building costs, aggregate basis, has to finance more than 50%. Technically, it's at least 50%, but you're never going to be exactly 50%. So I always say more than 50%. You have to finance more than 50%. The bonds are issued this year and the project's placed in service this year.
Yes.
Explain the transition rule for projects that are placed in service after 2025.
Yes. So if at least 5% of the private activity bonds are legit issued in 2026, then you as the project can take advantage of this 25% test rule. And so that is an allowance in the code. It's right there in section 42. That is where Congress permitted as a transition rule developments to take advantage of that if they're able to do it. Obviously, not every deal can do that potentially, but that's at least a possibility that the owners, the developers, the agency, the issuer can all think about and try to strategize towards.
Right. So the key being that at least 5% of your land and building are financed by private activity bonds issued in 2026 or later.
Exactly.
You're eligible for the lower test. And I will say, kudos to you, our Chief Public Policy Officer, Peter Lawrence, other advocates, as well as members of Congress and their staff for putting this transition rule in the actual statute. So we didn't have to go back and wait for Treasury guidance. Now, as most of our listeners know, we at Novogradac did produce estimates as to the number of additional units that could be financed with this legislative change. If you could describe the results of those estimates, I'd appreciate it, Mark.
Well, the most important aspect of it is the number itself, which is 1,143,000 more units or apartments over the upcoming 10 years. And so that is a gigantic consequence of this legislation that we estimate. I say we, I actually don't participate in that work very much myself. It's led by Dirk Wallace, to whom I report, and Peter Lawrence, as you already mentioned, also takes part in a lot of that work. So it's going to be of tremendous consequence. That's one of the things we're discussing today is how to make that consequence happen. What are the choices that the various policymakers need to make for that projection to become a reality?
And I would just add to that it is based upon the existing private activity bond cap being used for rental housing and not being redeployed in other areas. It also implicitly assumes gap financing scales relative to the amount of additional units financed. That being said, it does also take into account higher expenses or higher development costs and the like. And I do think that to the extent that gap financing, which we'll talk about more later, doesn't scale dollar for dollar, there is now going to be an opportunity to do more preservation. So I do believe being able to finance that many additional units over 10 years is real, depending upon, of course, how states react. So let's now talk about the basics of implementation. And I thought we would start by the kind of basically, if you think of a state that's saying, okay, we're not going to lean into the transition rule. We're not going to lean into other ways to accelerate the application, which we'll talk about, which I do want to talk about, because I think that's something that, if a state has the opportunity to do that, they should, because I'll get more total units. But if a state is taking the approach of, I want to think through all my options and come up with something effective on January 1, 2026, or if they're looking and saying we might want to delay even farther into the future or further into the future, which I certainly don't want to encourage, but I recognize that, some states might, for a variety of reasons, delay the implementation till sometime towards the middle to end of 2026 or even beginning in 2027. What are the basics in terms of how the rules would change to adapt to the lowering of the 50% test?
Well, let me just first note that to the extent you are looking at working in a particular state in whatever context, that NCSHA has a periodically updated list of policies that are out there. And as of when I last looked at it, there are 7 states that have posted some kind of policy to varying extents, and there's 10 that have said they plan to have some type of announcement later this year. Now, I have no doubt that's not all of them. There's certain many that are going to say something that just haven't said they're going to say it, but they fully plan to. And so the obvious change, of course, is to no longer be at 50%, but to drop it down to 30 or 27.5% as the maximum amount. A lot of states before this legislation, as you look at their current policies, would say that their maximum would be 55% or something in that range, give or take a few percentage points. And so the main change would be to drop that number correspondingly. But again, you wouldn't obviously take it to 25, since that is the cliff test. If you drop to 24.9, then you basically kill your deal. And so you got to have a cushion there to recognize the reality that that's a fraction, and the denominator of that fraction is not in anyone's control. That can go up at any point in time. And so there has to be a cushion in place. But there's all kinds of other policies that states can adopt to help make this a reality. One of my personal favorites is to have a preliminary application stage. If you do that right, it creates a tremendous amount of efficiencies for everyone. But again, the key is you have the right, you do it in the correct way. There are certain states where they might be able to have particular third-party reports that they get, like soils, boring engineering. Just as an example, some of those could become post-award requirements to put off some of those costs. And you'd still have to meet various requirements, but you meet them later in the process when it's easier, when you know you've got a deal. There's going to be a lot of these properties that are going to need, as gap filler, to get federal funds, but it's one thing to need it. It's another thing to incentivize it and to have people bring it into their project when they might not otherwise. And obviously it's great when you need it to get it, but if you don't need it, then adding expectations like following environmental review, following Davis-Bacon, things like that, you might otherwise not need, can be a questionable outcome potentially. And so those are the main things I would say. Then there's some other things you can do. So that's a process perspective. From an underwriting perspective, you can encourage what we at the firm call sidecar deals, where you've got a combination of 9 and 4 to help each of those help each other, basically.
No, I think the sidecar,
some agencies may consider.
I was going to say on the sidecar that it's something that I think of the sidecar transactions where you're, as opposed to being just a productivity bond 4% transaction or just a 9% transaction, you're either using the bonds to generate additional resources when you have excess basis for the nines, or in the way that you're thinking about it here, I think, is that the 9% ends up in essence being a gap filler in that the 9% subsidy is deeper than the 4%. So you can end up putting the two together to make a project that's financially feasible that wouldn't be feasible as a bond finance transaction alone.
Yes, thank you. Exactly. And that 9% deal gets the basis boost, even if not through the QCT or DDA, through the agency designation ability for it. And as I recall, there's a podcast going into depth about that as well.
Yes, there is.
And so, yes, some agencies might be able to reconsider some of their reserve expectations. Some of these deals maybe have more of those than they need. That's a matter of research and analysis and feedback. And then it's a simple reality that the more developer fee a deal has, the more feasible it can be. And so obviously there are some limits on how much a developer fee can be in a deal and still pass appearance public policy perspectives, but the math is what it is. The more developer fee that goes into a deal, the more feasible it can be, including even if it's deferred. So those are just some high level thoughts as to what a state could do if they wanted to try to expedite and further enhance implementation next year.
Now, thank you for all of those. And there's obviously a lot more that we had time to discuss them all, or not that we know them all, but we could surely discuss more.
Right.
I did want to emphasize your point about, many states right now will put a cap at, say, 55% on the amount that can go to a given transaction. And that's so they have cushion under the 50% test rule to have slight cost overruns, but still meet the overall 50% test. And they'll cap it at 55%, maybe to state the obvious, so you can do more transactions. If an individual project is getting 60 or 65% of bond cap, then there's less bond cap for other transactions. And to the extent that you're oversubscribed, it basically means that you won't do quite as many if you go up to, say, 65, whereas if you go down to 55, you can get more transactions done. Similarly, when it goes down to a 25% test, the sort of 55% equivalent is 27.5%. So that's the magic. You might be thinking, why 27.5? It's just because it's 10% cushion on the 25% test, just like 55% is a 10% cushion on the 50%. That said, we've definitely heard others suggest 30% as a floor, or at least the minimum amount you should get. You shouldn't get less than that. There's no magic to 30 versus 27.5, other than it's more. And there are some who are suggesting that an individual project should get the maximum of 30% or the amount it can support. And if it can support more, you should give it more bond allocation. And I would just note that when a state housing agency does that, to the extent they're oversubscribed, they're making a choice to get more bond allocation to a given development. And as a consequence, not get as many developments funded if they're oversubscribed. And by not getting additional funded, you're not getting additional 4% tax credits. So it definitely comes at a financial cost in the aggregate. So that's just something that I think state housing agencies should be thinking about as they're going about creating these and assessing what the right percentage is. And I recognize that one size does not fit all here, but I just think it's important to be pointing out the impact of various choices.
Absolutely. Yep.
Now, that's kind of the base. I think of this as like the baseline in terms of what we would expect, most, if not all, state housing agencies to be evolving towards with the lowering of the 50% test. Some states, though, are really leaning in to the lowering of the 50% test. And in essence, taking steps in 2025 to get the benefit of the lowering of the 50% test for transactions that they're looking at this year that aren't going to be placed in service until next year or later. And Mark, if you could describe some of the ways in which states are doing that, I think our listeners and viewers would find that really helpful. And we might even motivate one or two states to take that approach.
Well, and really just have to call out California here for multiple reasons. It was the first out of the gate with policies. It's the largest state, and it's where the firm is headquartered. And so Thomas Stagg wrote a great blog post going into detail on this. I'll just hit the highlights of it. And so they created an incentive for developers to reduce their volume cap requests. And so you could get more developer fee, or you could be more competitive in future applications. And California is very much a bond oversubscribed state. And so if you're a current year developer, odds are you're going to be a future year developer. And so they, as I understand it, the consequence of those policies was to get back 9 figures in bond volume. I don't know the latest number, but the developers responded very much to that proposal.
And just to unpack that a little bit, the last number I heard, a rough estimate was 600 million. I'm not sure what the actual number is, but it was the rough amount of bonds that were returned. And in essence, California would be taking that 600 billion and carrying it over to next year. And then the bonds would end up being issued next year. And since they'd be issued next year, financing projects next year, that 600 million in bonds, if that turns out to be close to the right number, I mean, that could finance more than 2 billion in overall land and building costs. I like to say that ain't nothing.
Right.
That's a lot of additional housing that would end up getting built by virtue of carrying these bonds forward. And I know of other agencies that are similarly taking their applications this year and saying, we're going to carry them forward. We're going to carry our bond authority forward next year and then issue the bonds next year and then finance the projects next year, so that also there are bonds this year. If they were issued this year, as a general matter, projects would be subject to 50% test. By carrying it forward, it'll be the lower test. I will also note, though, that it's also, a state could also decide for bonds issued this year, they could simply choose to finance, say, 20% of the project, as long as the project's not going to get placed in service until next year. And then next year, they could finance, say 7.5% of the project. So it meets the 5% test next year and ends up being eligible for the lower 25% test. So I sort of think of it as states can lean into getting more housing units out of current year, out of 2025 bond allocation, by either choosing to carry forward the bonds and issuing them next year, or only funding projects to the tune of, say, 20% and funding more projects, but committing to do the extra 7.5% or at least 5% next year, so they're eligible to be subject to this lower finance by test. And I definitely, to the extent possible, would encourage state housing agencies to take one of these or both these approaches. And I recognize that it's not true for every deal, and it's not true for every state. And there's a variety of issues that states have to deal with. And I'm just dealing with a narrow technical tax point. So I'm just making that observation, encouraging it, knowing that, the reality on the ground won't make this possible uniformly. And every state will have to be addressing it in what suits their housing needs and their developer community.
Indeed. And I know one of my clients would want me to point out that there's a limit on how many years you can carry forward your bonds. And so there could be a point at which if you have bonds that are in their third year being carried over, then this wouldn't be a possibility. It's just, but like you said, it's just one of the many state specific realities that they have to take into account. And all we can cover here are the generalities.
No, that's exactly right. And there is a limit to what can be carried forward. And then there's also the ways that, anyways, I could go down a number of different rabbit holes now. That's not going to stop.
Sure.
I'm going to start filling in a bunch of buts. But, the observations you are making are accurate, but they have to be addressed in a broader realm of issues, which is why, it's all about consensus building among the state housing agencies with all the various constituencies. Now, when we talk about lowering the 50% test down to 25%, And I mentioned that some advocates are saying a project should be entitled to the maximum amount they can support. And if it's more than 27.5%, they should get more. And I made the observation that to the extent that you do that in a state that's very competitive, it means you're probably going to get fewer total housing units for the same amount of bonds. But the listeners or viewers might be wondering why advocates are for that. It's because if you do get a higher amount of private activity bonds and your project needs that debt financing to be feasible, if you lower the amount of private activity bonds, then the developer is going to have to go out and get taxable bonds. And taxable bonds, generally speaking, are issued at a higher interest rate because the interest on the bonds isn't tax exempt. Now, as the 10-year treasury is getting close to 4% again. So to the extent that as it falls, that rate benefit does decline as well. But all things being equal, clearly taxable rates are generally higher than tax exempt rates. So when you lower the tax exempt bond financing, you do increase if there's a financing gap, you increase it. If it was just balanced, then you're creating a small financing gap. I will note that the amount of that financing gap that you create on a given project dwarfs in comparison to the amount of additional 4% tax credits you get by doing one more deal, or however many more deals you can do because of the rule. But that being said, for an individual project, there is a slightly wider financing gap. And one approach some states are now looking at, and it's not easy to do, but there's something called bond recycling. And if you could just speak briefly about bond recycling more. Neither of us are bond attorneys,
Right.
but at least describe the economic benefit to a project if they can be allocated, quote, recycled private activity bonds.
Right. And the key as I understand it, with bond recycling is it's all about timing and having the things happen that need to happen in a particular sequence. And as I understand, the first point in time is 4 years after issuance is within that time frame is when the bonds need to be redeemed. And then you've got 6 months from that point to then recycle the bonds. And so the way to make this work, at least with the multifamily side, but really, I think, as I understand it, maybe you could even use other types of bonds to be recycled, but is to look and see what's out there and what's potentially going to come up to be redeemed and see. And it's possible there won't be much that or at least the timing won't be very convenient. But if you're a state agency, in my assessment, you at least have to try to ask that question and maybe most of these states have some type of third-party expert that helps them, like with their single-family bond lending activities. And so getting that professional to help look at this circumstance to see what their possibilities are. And again, it may be nothing, but it's definitely going to be nothing if you don't try and you don't look. And so you at least got to take a chance and ask the question.
And I would just say, with respect to the recycle, the multifamily residential bonds, many states, when you ended up having to finance at 50 or 55%, a lot of projects couldn't support that amount. So those bonds were getting paid down. And to the extent those bonds are paid down, the taxes and bond benefit is lost because the project no longer has they have lower principal amount, but they don't have the benefit of the rate arbitrage that you get on a taxable versus a tax exempt rate. Those bonds are getting paid down through bond recycling. They can be those multifamily bonds can be reissued for other multifamily developments that meet certain requirements. So the thought is that the recycled bonds could be used to fill the gap that projects might have, so they don't have to go out and get taxable debt. They could fill the gap between the 27.5% and whatever the project can support with these recycled bonds. And the key with recycled bonds is you're not eligible for 4% credits if you're financed by recycled bonds. They don't taint the project. It just doesn't bring credits with them. And that's why, many states haven't had bond recycling programs because they didn't have projects that were getting less than what they can support. Now, many states are going to find that they have projects that can handle those higher amounts of debt because they're being financed at 27.5%. And they've got projects even placed in service that were at the higher 55% level. And they can pay the higher 55% down. They'll pay it down to wherever they can support. And that creates this opportunity for bond recycling. And it's definitely only going to be for a few years, because then that's going to run out. And I've probably already confused most viewers and listeners.
Well, I guess what you
could say was technically accurate. You can
Indeed.
correct me if I'm wrong, Mark.
No, it's no correction, just a rephrasing. It's a very specialized, unique form of potential gap financing that is out there if you capture it in its magical right moment. And if you do, then it's there as lower interest debt to be used. And if you don't, then it just evaporates and disappears. So you ought to at least try to capture it.
Much better way to say it. So thank you for that. Now, one of the concerns that I know many others have is that some states might end up looking at the amount of productivity bonds are allocated to residential rental housing and say that, well, now I just don't have to allocate as much and I can do the same amount of volume and I could take it and use it somewhere else. And I've written a blog post, probably more than one, in a Washington Wire article on the reasons why productivity bonds, or let me say it differently, residential rental housing is a very good use, a very efficient use for states for productivity bonds. And I feel like residential rental housing should always be first because of the federal match concept. So please, if you could describe for the audience the federal match concept of using productivity bonds for residential rental housing.
Absolutely. Well, my new favorite way to explain it is if you have two credit cards, use that as an analogy. One of them you get from an airline that gives you bonus, double, triple miles for buying plane tickets, and another that's just from a bank that doesn't give that same benefit. And so you have a trip, say, to Hawaii coming up, and it's time to buy your plane tickets. Which one are you going to use to buy it? Well, the answer should be obvious. And yet, for some reason, there's a lot of states out there that use their regular bank card to buy the plane ticket when they could use the other one and get the extra bonus miles, except to a point that Mike made earlier when we were talking about this and getting ready, that even that understates the consequence of this. And so there's no other use of private activity bond volume that generates any kind of additional subsidy, let alone one of the consequence of the 4% credit. And so it's, I think it's arguably at least irresponsible to use it for anything other than rental housing to the extent that there's demand that's not met for that rental, to the extent that you're oversubscribed. And so, and there's actually multiple other reasons. Peter Lawrence and I wrote a blog post about it. I think it was 2020, maybe. It was a while ago, where we make other points about how you serve lower income tenants. The agency can make plenty of revenue from this because a lot of agencies are self-supporting. They don't have any choice but to generate revenue from their activities. And so the reasons go on and on, but the fundamental one, the most important one is, again, this is the one that generates the 4% credit.
And I will link to some of our prior posts because I know that, some developers have wanted to use some of these arguments to demonstrate to states why they should prioritize productivity bonds for residential rental housing. And as Mark mentioned, the productivity bonds bring a lower cost of funds to the residential rental development, just as it would for single family homes and the rest of the other uses of productivity bonds. But it does come with this federal match of these 4% tax credits on, the entire development. And that dollar wise is overwhelmingly positive. So that, as Mark mentioned, the other uses as a general matter don't have any leverage effect. There was a small one for transit that I'm not going to go into, but it wasn't as powerful as the 4% credit, but it did have a bit of leverage in it. But the fact that you get these, it's almost like, the federal government saying, if you choose to use it for this purpose, we're going to give you extra money. And that's something that I think if states viewed it that way, I think more states would say, give it that extra money. If I want residential rental housing, then I'm going to take that extra money from the 4% bonds and use my productivity bonds there. And I'm going to take other resources I have at the state level that otherwise would go to residential rental housing and take those resources and put it in the other area, and there's a positive arbitrage there. It's almost like the provider tax that the One Big Beautiful Bill Act is sort of phasing out, at least in part, which I won't go into that either. But it definitely is something that I think state agencies should be reviewing the value of PABs going to residential rental housing and assessing that when they make their choices among the various activities. So Mark, one of the other questions we get a lot is about the scalability of the soft financing. And, when we were doing our unit financing estimates, we assume the same amount of productivity bonds. And then we also assume that, soft financing would scale. Some soft financing does scale. For instance, property tax exemptions. You might not think of property tax exemption as soft financing, but a property tax exemption does mean you have lower property taxes, so you can borrow and support more hard debt, which is a way of filling the gap. So that's a type of financing that does scale, but not all soft financing scales without acts of state legislature, local governments. Please share your thoughts about, opportunities to scale soft financing.
Well, as we were talking about this, we hadn't planned on me sharing this thought, but it just came into my head, thinking back to many years ago. I was having dinner with someone you knew very well, David Resnick, and he was just a delightful, fun person, all these great stories. But the one time when he got really serious, when we were sitting next to each other at an industry dinner, and was when he said, "You've got to use your soft financing, your subordinate debt for bond deals, because otherwise they're just not going to be possible." And, and this was, again, maybe 20 years ago that he made that point. And his words of wisdom back then are still true. There's a lot of these deals that are just not going to happen without getting whatever local funds are available, local or state resources are available. And it's true that those dollars are very limited, but there's hardly any better way to truly leverage them. And there's any number of ways that people talk about leverage, but as I see it, true leverage is when you make something happen that wouldn't have occurred otherwise. And so even if you're putting in $60,000 a unit of your trust fund dollars, then that may sound like a lot, but if it's making possible a $350,000 apartment that otherwise wouldn't get built, that's true consequence. That's true leverage. There's no other way to make that deal happen without it. And so that's the choice that localities really need to make, and state governments too, is to what extent are they putting their dollars into these different activities? Where are they really getting the outcomes? Where are they really getting the consequences? And it's really hard to beat making bond deals possible that wouldn't be otherwise.
And I would just sort of note that when we talk about, soft financing scaling, some scale automatically, like I mentioned, the property tax exemption, even though some might not think of property tax exemption as soft financing, but indirectly it clearly is a subsidy that scales with, doesn't matter how many times you use it, there's the same amount available for each transaction. Some states, I have no doubt, will increase state tax credits. They'll provide other resources at a larger volume in order to help fill these gaps. But I also think you could be looking at it if you were a state housing agency and saying, I have 9% transactions and I have 4% transactions. The 4% need some level of additional soft financing if I wanted to do new construction. The 9%, I have the ability to deem it to be a difficult to develop area, 30% bonus and all the rest. So to the extent I'm a state housing agency with various soft financing resources, I'd probably want to give more 9% to the 9% deals and take the soft financing there and move it into productivity bonds. And it's true, I won't get as many transactions through the 9% because I'll be giving more to a given transaction, but I'll be freeing up soft fund and just basically shifting where I use my soft financing. And I think localities could do the same. So there's definitely ways in which you can take existing soft financing and move it around to maximize the combination of the two tools. And once again, I recognize that it's not like everyone can get in the same room and work on it the same way, and there are challenges of doing this, and no one will maximize it and optimize it completely. but it is something to be thinking about as you're making the various choices to maximize the production of 9% and 4% transactions in a given state to finance the maximum amount of residential rental housing. And then the other point I would just make, and I'm curious your thoughts, Mark, is to the extent that soft financing doesn't scale proportionately, generally the proportionate scaling is needed to do new construction. It does create resources for preservation. And the states that are oversubscribed or at parity, many of those states don't have a lot of demand for preservation, but there's not bond value available for preservation. And as a consequence, folks aren't even applying. And preservation transactions generally do not need near the level of soft financing as a new construction. So I am looking at this lowering of the 50% test as an opportunity for transactions that have been or owners that have been in search of additional renovation dollars to maybe have a window where they can go in and apply for an AC rehab and extend out the low-income restrictions and renovate a property that's been in service for a number of years and it needs some renovation dollars.
Absolutely. And I guess maybe another way to make the point that I believe you're expressing is if you've got two different projects, a new and a rehab, and that each are going to say be $20 million deals, and you've got $4 million of soft money that's sitting around trust fund, whatever it may be, that may not be enough to get that $20 million bond deal over the finish line. Its gap is bigger than that, but it's more likely to be enough for the preservation deal for it to happen. And it's true that you're not creating new housing with that preservation deal, but you could be dramatically improving the residents' quality of life. And a lot of these properties, they did not get enough support from the various whatever federal source it was from HUD or USDA to properly keep the place up. And so, or it's just, even if they did, it's just obsolete. It's old and needs better facilities. And like HVAC systems, they just wear out and they're inefficient. And so that $5 million that you have, or I forget what number I said, 4 million that you have available, that could make that preservation deal happen when the new construction deal would have needed more.
And I'm also sort of just observing that as a state is thinking through their allocation plan, they might be thinking, well, I don't have enough soft financing to support all the additional units that could be built if they were all new construction with this lowering 50% test. So I want to go ahead and let projects apply for more than say 27.5% or 30%. And I'm just saying, rather than do that, you could still put the cap on and then let projects apply and basically see what the market bears. I think many states will find, if not all states, that there's enough preservation need that preservation transactions will come in and absorb that extra amount that you made available, but couldn't make available, or there wasn't demand for new construction. So Mark, I appreciate you being on the podcast, and I would encourage all of our listeners and viewers to reach out to you if they have questions on any of the topics we've discussed or other questions around state housing agencies and the application process for state credits, application process for private utility bonds, and kind of all of the above. I'll include your contact information in today's show notes. And I do like to always ask my guests what other resources that you recommend to our audience for them to learn more about the topic we've discussed here today.
Well, for the ones we've discussed here today, the best ones, of course, would be to sign up for the working group, the low-income housing tax credit working group. It's not too late, depending on when you listen to this podcast, to come to Nashville. And it's almost certainly not going to be too late, depending on when you listen to it, to join us in Las Vegas. But the resource about which I'm the most excited is I'm offering through the firm and through some guest speakers our 6-week basics in an underwriting allocation class starting up in October through November. And so it meets once a week. And so you can sign up for that on our website.
And I will include a link to all those resources in our show notes. And to the extent that there's anything that we mentioned that you have difficulty locating, please reach out to Mark or cpas@novco.com or reach out to me and we'll fill in the gaps. So Mark, please stay around for our off mic section. But before we go there, I do once again, as I do every week, encourage our listeners and viewers to subscribe to Tax Credit Tuesday on whichever platform you get your podcast. And if there's a platform we're not on that you think we should be on, please email it to cpas@novco.com. And then if you're watching on YouTube, please take a moment to like or comment on the video. If you like or comment on it, it does help raise our visibility and assists others find the show. And then I also would encourage you to share the podcast with colleagues. Tax Credit Tuesday is an excellent way to learn about and stay current on the many tax incentives that are available for community development, affordable housing, historic preservation, and the like. So with that, let's turn to our off mic section where we have an opportunity, or my guest has an opportunity to give a shout out to someone working in the tax credit community, someone worthy of recognition. And there are many, so we're never at a loss. Mark, who would you like to shout out?
Well, and just like the first time I did a shout out, this one was very obvious and easy for me to pick. It's my friend and former coworker, Russ Griffin. He started with the North Carolina Housing Finance in the 90s and was at the time in charge of the design and construction process, and immediately started making improvements and kept making improvements the whole way through. Was a leader nationally in implementing fair housing accessibility requirements when a lot of people weren't even paying much attention to it, and continued to think of ways to make the processes better through things like a construction field guide and other various just constant attempts to make everything better and improve. And so he retired from the state in July after all that time, and is now working for, is now working for a property management company in Fayetteville, Remnant. Shannon Powell is one of the best management companies in the country. And so I'm doing compliance work with them. So very honored and happy to get to recognize him.
Great. Thank you for that. And thank you, Russ, for everything you've done in the past and for staying in and serving low-income residents and helping provide safe, affordable rental housing. Thank you for being on the podcast today, Mark.
Absolutely. Thank you for having me.
And to our audience, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.